Hi, and welcome to my second quarter outlook video on how to navigate an aging bull market. My name is Dan Timotic, and I'm a managing principal and one of the portfolio managers at T2 Asset Management. This video is designed to explain what happened in the first quarter, how I'm positioned going into the second quarter, and some of the things I look at when making investment decisions for clients. It'll also provide you some ideas on how to segment your portfolio to reduce the number of emotional decisions you make that can lead to some problems. As always, if you have any questions or comments or simply want a second opinion on what we're currently doing, please send me an email to dtimotich@t2asset.com, and I'll be sure to follow up with you. Before we get started, a short reminder, this video is for educational purposes only. The opinions expressed in this video are mine and do not reflect the opinions of other portfolio managers at T2 Asset Management. You should always consult with a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, let's get started with some of the topics we're going to cover here. We're going to go over the first quarter review, what happened. We're going to jump into a detailed explanation of my four-part framework. Talk about the current state of the markets, and then finally talk a little bit about how you can construct your portfolio and how to better segment your investments. All right, so last year, many of you may already know that my investment thesis was predicated on reduced regulations, pro-business policies, tax reform, and overall fiscal stimulus. We didn't see any volatility in 2017, and while volatility was expected to pick up in 2018, I think the level of volatility that came was a surprise to many. After we saw a great start in January, the markets seemed to just collapse in a very short period of time and caused a lot of anxiety in the markets in general. So why the drop? There's not really any single answer, but I think there's a few factors that sparked the sell-off. First, we had just come out of a strong 2017, and many investors had to sell some of their equity exposures to get back in line with their targeted allocations. Second, economic data had been strong, and many had feared that the new Fed chairman would be more aggressive in raising interest rates. Third, the 10-year Treasury rate spiked to over 2.8%, and that spike forced stocks to adjust. And finally, there were a lot of positions in leveraged derivatives products that were betting on low volatility. Once this volatility showed up in the markets, these leveraged positions were forced to unwind, which caused a bigger than expected sell-off. Thankfully, the market in general recovered a bit, and we ended the quarter with only small losses. We were down about just over 1.2%, and while nobody likes negative quarterly numbers, this is the first time we experienced a negative quarter since the third quarter of 2015. Now, while much of the media was focused on the stock market, very little attention was being given to the bond market. This is a chart of the Barclays Aggregate Bond Index, which is a broad measure of the bond market, and as you can see, it did worse than the S&P 500, and it was down almost 1.5%. This is concerning given that many investors have exposure to bonds to offset the volatility of the stock market, and yet in the first quarter we saw both of those were negative. Looking at this next chart, you can see that drawdowns we experienced in the first quarter were significant. Many of you may think that this is rare, but in reality, they happen much more than you think. During normal market conditions, we often have 10% corrections. We just haven't experienced some of these in quite some time. The good news for the quarter was that the market retested the February low twice and held up. Indicates to me that the market's not yet ready to roll over. So let's put this recent correction in perspective. I took a look at the SPY, which is an ETF that tracks the S&P 500 index over the last 8 years to see what kind of drawdowns we experienced and what happened after those drawdowns. As this table shows here, we had quite a few. However, after each of these pullbacks, we had great performance 1 year later. The markets are always climbing a wall of worry, and people always claim that this time is different. So let's just kind of go down memory lane real quick to see what had happened in the past. In 2011, we had the Eurozone crisis, and we had two major drawdowns, and the net result was that the market was up over 20% a year later. In 2012, we had a presidential election, and we had a fiscal cliff looming, and yet the markets recovered quite nicely a year later, being up over 30%. In 2015, China's economy was slowing and oil prices were falling, and that caused two big drawdowns. And again, the market recovered nicely. I'm not saying that you should ignore these drawdowns completely. What I am saying is that in order to understand the situation, you need to have a more comprehensive understanding of what's really happening. So, as bad as the media made it sound in the first quarter ended with only small losses, thankfully. From a sector perspective, there were a couple of positives. Consumer discretionary and technology ended the quarter in positive territory. I did have an overweight to materials and industrials in 2017, and I did sell out of those positions at the end of February and the beginning of March, which was just prior to those sectors rolling over and experiencing losses. So that worked out pretty well for us. As far as other adjustments that are concerned, I had an overweight to technology. I continue to hold an overweight to technology going into the second quarter. When I sold out of the industrials and materials, I took those dollars and added international exposure, as well as added to my existing small and mid-cap stocks. In terms of fixed income, I held an overweight to investment grade as well as high yield credit. I do prefer to own credit risk in this environment over interest rate risks. We'll talk a little bit about the flatness of the yield curve and why that's the case, but I continue to maintain an overweight to the investment grade and high yield credit sectors of the fixed income market. Okay, so before we get too into the framework here and jump in, I think it's important for viewers to really understand that financial markets are complicated, and it takes a great deal of research and analysis to understand what's going on. Obviously, I can't walk you through everything I look at for my clients, but hopefully this framework will give you a higher level understanding of my process and why I think it's a better way to evaluate the current environment we're operating in. So let's get into the framework here. Successful investing, in my opinion, requires a really thorough and comprehensive understanding of these four major parts. Very much like a car, when you're going from point A to point B, you're going to need all four of these things to work together. You can't get there with just the engine or the transmission. You need the engine, transmission, gas, and tires. Similarly, if you're looking at whether you're saving for retirement or just your investment portfolio overall, it's important to understand all four of these components: how the economy is looking, what's going on in earnings, what prices are you paying for these investments, and finally, what are the markets telling you? So when you take a look at all four of these components together, I think it's going to paint a better picture for you. Each of these components do have their shortcomings, and they do have their weaknesses. So we'll kind of touch on each of these individually and let you know a little bit more about why you can't look at each of these in isolation. So let's start with the big one, the economy. This is really the foundation on which everything else is built. So it's important to understand what kind of backdrop we have as in terms of the macroeconomic environment. As you can see, this chart right here represents real GDP growth of the United States. GDP measures all the goods and services that are produced in this country. And as you can see, since the last recession, the real GDP numbers continue to grow, and it's upward sloping, which is a good indication that the economy continues to expand. Now, 2/3 of the U.S. economy is consumer related. So in order to understand what's really driving GDP growth, it's important to understand what's going on with the consumer. So let's take a look here at real median household income in the United States. Obviously, this is a pretty volatile number. This goes back prior to the last two recessions back in 2001. And as you can see, when household incomes start to deteriorate, it's really indicating that there's going to be a lot more economic problems ahead. And as you can see, we had a recession there in 2001. Into 2002, we had another one from the housing crisis, and each time those were met by significant deterioration in household incomes. The good news is that since 2012, it appears that the balance sheets of households have improved, and we're starting to see household incomes on the rise again. But given the volatility of this, it's important to understand that we as a country do not simply spend what we earn. We spend plus some credit. So let's take a look and see what the credit environment looks like in the U.S. This chart here is a representation of how much outstanding credit there is, both on the household level and for nonprofit organizations. As you can see, we're approaching roughly about $4 trillion, and it's continued to grow over the years, with the exception of 2008 and a quick little blip here in 2015. It's been upward sloping. This isn't necessarily a bad thing as long as wage growth continues, employment's strong, and people have the ability to repay their debts. But obviously at some point, this is going to become problematic for consumers, and it's going to put pressure on them. So it's something that we just wanted to watch in terms of its own implications in the event that we do enter and when we enter into another recession. So now when you look at the economy, and many people do just simply look at what's going on in the economy when they're making investment decisions, you have to be very careful. I mentioned earlier that each of these components have their strengths and weaknesses, and one of the weaknesses when looking only at GDP is that it's backwards looking and it's delayed in terms of what's really happening. So if you took a look at these two charts, for example, the top one shows that the economy is expanding, and you would think that things were just fine. The problem is that that was immediately before the tech bubble burst and we saw a recession. On the bottom graph, similarly, you would be thinking that the economy is expanding, so that's all good news, except that is what the chart looked like immediately before the housing crisis had happened. So again, this tells you a lot. You always want to have positive GDP growth in the economy, but looking at it in isolation could lead you to make some poor decisions. Continuing on with the economy, one thing that I mentioned earlier is that 2/3 of the economy is predicated on the consumer. So it's important to understand what the employment picture looks like. This chart here represents the one-month unemployment rate, which is the black and red line, and the blue line is the moving average of the unemployment rate over the previous year. So if you take a look here, back at the end of 2000, we saw that the 1-month unemployment rate crossed over above the 1-year average, moving average, and that was indicative of problems ahead in the economy. We did see the same thing happen in the middle of 2007 when that number crossed over, and obviously we entered into a recession and had the housing collapse. Now this is a shorter term view. This is probably more of a yellow caution light when this kind of thing happens. It's a little bit more telling if you pull back the lens a bit and take a look at a little bit of a longer moving average. This next chart here is the same monthly unemployment rate, but the blue line, instead of it being a 1-year average, it's a 3-year average. And this, I think, provides a better picture of what the economic conditions are going to look like in the near term. When you take a look at the end of 2000, we did see that crossover happen, and that was followed by a recession. At the end of 2007, we saw the exact same thing, and it was followed by a pretty ugly recession. And as you can see today, we still are quite a ways away from that. Again, you don't want to just simply look at the GDP and these unemployment numbers to paint the whole picture, but this is just one factor to consider for those of you that may be concerned that we're going to be entering into a recession relatively soon. And I don't see that yet, and we'll get into a little bit more detail about some of the other things we look at to give us a better idea. Moving on to earnings. Earnings are what you're buying when you invest in the stock. You're buying the future earnings of companies. So these are the things that you need to really pay attention to in order to understand how much you're paying for and for what. If earnings are increasing, it's a good thing. If earnings are falling, that's a bad thing. And depending on what level you buy those earnings at, you could either be in for you're going to be in for a surprise one way or another if you do not understand what earnings are really telling you. So this chart right here is the S&P 500 earnings per share. It's inflation adjusted, and as you can see, and as you could probably expect, since the last recession, we've seen EPS grow significantly. I think it's been a combination of two things. One is stock buybacks were alive and well throughout the last 10 years, and earnings have grown over time. We'll take a look at some charts that show what sales have looked like. But basically, for earnings per share to grow, you'd need one of two things: sales to grow and earnings to grow, and the level of outstanding shares level. Or you could have sales numbers stay at the same level, earnings stay at the same level, and you just have fewer shares to divide those earnings against. So either way, it was a combination, I think, of the two things over the last 10 years, but nonetheless, earnings continue to grow pretty nice. Mentioned about sales growth. As you can see, this chart here represents the sales growth rate of the S&P 500, and obviously the last recession we were in caused significant deterioration in sales, and took a little while to rebound and peaked out about 2012. And then it was continuously falling up until about 2016, where it turned around, and it looks like sales have picked up quite nicely here. In addition to seeing what earnings look like on a quarterly basis, one thing that I like to pay attention to is what the guidance looks like from companies. Every time companies report their earnings for the previous quarter, they're going to provide you some context of what they see going forward. And this chart right here represents what the earnings guidance was like in the first quarter versus a 5-year average. And as you can see, technology, consumer discretionary, healthcare, industrials, materials, staples, all of them had very positive guidance relative to their 5-year average. And that tells me that companies are confident that the economy is going to continue to grow and that the consumer is healthy and that they're going to continue to increase sales. The one problem with earnings, as we mentioned earlier, each of these have their weaknesses, is that earnings forecasts are rarely right, very much like economic forecasts are rarely right, just like weathermen are rarely right unless they're predicting what's going to happen in the afternoon. Anybody that tries to tell you what's going to happen too far in the future has a higher probability of being wrong, and analysts are no different. If this chart here is a little busy, but if you take a look at the brown line right there, that represents what the earnings forecasts were in 2009 for 2011. So they were basically looking at things 2 years out. As you can see, in 2009, analysts were forecasting earnings to grow about 23% by 2011. And what happened was those expectations continued to be ratcheted down. We saw the same thing in 2012. We saw the same thing in 2016. 2018 was an anomaly, it looks like here, because earnings expectations were so weak in 2016 that once we actually started to see some economic expansion and some reforms, both from a regulatory perspective as well as from a tax perspective, those earnings expectations have increased. And as we are recording this video right now, we're at just the beginning of the earnings season, and thus far earnings have just been terrific. So we hope that the earnings reports continue to come in strong, but we'll just have to wait and see. Now, moving on to valuations, if you're looking at valuations, this is what you're paying for the future earnings of companies. And so there's a number of different ways to value stocks, bonds, and other investments. One of the things that is popular is what's called the PE ratio, and that's basically the price you're paying for earnings ratio. And there's two ways to look at it. There's what's referred to as trailing 12-month PE and a forward PE. The trailing PE is based on what was already reported over the last 12 months, and the forward PE is what the market is being priced at, giving forecasts of earnings. And as you can see here, most of the sectors based on trailing 12 months are somewhere around 20, 21. Healthcare's on the higher end of things. But on the forward PE measure, you see that there is some pockets of value. Now, as I mentioned earlier, forecasting earnings is not a very accurate measure, but at the same time, if earnings do continue to come in as strong as they are, you could see that there is some potential for upside on stocks, and we'll talk a little bit about what my expectations are later. If we don't realize those expected earnings, then there's going to be a potential for pressure on stock prices, and we could see another pullback. Same thing across market caps. If you look at small caps, mid caps, large caps, they're all right there about 2021, and the forward PE ratio on those is a little bit lower. I did make a couple of changes in the first quarter. I added international primarily because it was cheap relative to the S&P 500 on both a trailing basis as well as on a forward basis. Small caps and mid caps, as I mentioned earlier, not only do I expect the lower tax situation for them to be beneficial, but also the regulatory environment with the reduced regulations. I think that's going to be a positive. Now, this is simply the way we look at the stock market, one way we look at the stock market. The other market is the bond market, and the bond market is a very telling market. It could really give you a lot of information in terms of what's going on, not only from an economic perspective, but also from a credit appetite perspective. So let's take a look at what the U.S. Treasury yield curve looks like. The normal yield curve of the Treasury market is upward sloping to the right, and as you can see, back at the end of December 2015, it was upward sloping to the right, and it currently is as well. The difference being is that it did flatten quite a bit, meaning that the 30-year Treasury did not really move much, and the 2-year Treasury did increase. So that's indicative of a Federal Reserve that's raising front-end interest rates, but the flatness of the curve is something that we want to be concerned about and watch out for, because it's indicating to me that the bond market is not overly optimistic of long-term economic growth. But again, we're going to go into the next chart that's going to give us a better idea of how flat the curve is. This is a little bit busy. The top line right there is the difference between the 2-year Treasury rate and the 30-year Treasury rate, and that basically measures the flatness of the entire yield curve. The middle line measures the long end of the yield curve, the 10-year Treasury to the 30-year Treasury, and the bottom line measures the front flatness of the yield curve, the difference between the 2-year and the 10-year portion of the yield curve. When you look at this red line here, this indicates that there's no difference between those two data points. So on the top line, if you will, when you look back in 2000, we saw the yield curve invert, which means that you were earning more on the 2-year Treasury than you were on the 30-year. And that's a problem because that is indicative of future economic pressures. And we could see that the same thing happened on the long end of the curve as well as the front end of the curve. And inevitably, a recession is around the corner. In this particular case, it took about a year and a half, so it's not an immediate concern. But we did see the same thing happen in 2006, where the yield curve may not have fully inverted for a long period of time, but it did remain at virtually a zero flatness level, and that 2 years later we ended up seeing a recession. So the level of the yield curve's flatness is important, and as you can see right here, we're not quite there yet. We're close, so we definitely want to pay attention to this, but we're just not quite there yet. So if you take this in conjunction with the unemployment graphs that we looked at earlier, you can see that we still have a ways to go before we expect any sort of recession. Now, that was simply the risk-free Treasury curve. The other component of the bond market is the corporate bond market. And when you look at this chart here, this is basically the BAA corporate bond spread curve. And this is your typical run-of-the-mill investment-grade bonds, industrials, kind of like the mid-America kind of companies that everybody knows. And what this is measuring is how much risk appetite investors have for corporate credit. And as you can see, the yield curve here, or the spread curve, has been falling really since 2016. And that indicates to me that investors are much more comfortable owning credit in this environment. The tighter the spreads are, the less concerned investors are about potential defaults or the ability of these companies to repay. Now, we did see a little bit of an uptick here this year in terms of spread widening, but to put things in perspective, that's only about 20 basis points or so. And to me, it's important to see what happened in the high yield credit market, because my guess is that a lot of these bonds were sold and caused a little spread widening so that investors could add exposure to high yield and possibly even equities. So let's take a look at the high yield market. Same spread chart. The difference being is that when the chart is going up, it's indicative of concerns with regard to the ability of these companies to repay their obligations, and or investors are just demanding a higher risk premium for these bonds. When things are falling like they have been since 2016, again, it's a good indication that people are comfortable with owning credit risk, and they're not too concerned about the ability of these companies to repay. Now, this looks like it's a pretty volatile and a big spike here in 2016. So let's pull the lens back a little bit and take a look at what happened on a longer-term perspective. So when you look here, obviously in the heart of the last recession and at the heart of the housing crisis, we saw high-yield bonds spike significantly, and that was an indication that people were just deathly afraid of owning anything that was associated with risk. And as you can see, since then, we've just seen the spread in high yield continue to come down. We saw a couple of spikes, short-term kind of spikes at the end of 2011, as well as again in 2016. But spreads remain relatively tight, and it doesn't appear that they're widening out significantly. So I don't see a lot of risk in terms of the risk appetite in the market. But that being said, these things can spike. And so again, the problem with if this is the only thing that you're looking at and you start to realize that there's a lot of complacency in the high yield market, you could be in for a surprise when spreads do start to widen out. So it's important to pay attention to this. All right, moving to markets. It's important to know what's going on a day-to-day basis. I realize that people are busy and you may not have the time to follow things on a daily basis. That's why many of you hire us. But the markets are really telling you what's going on real time, and it's telling you what real money's doing. So if you're ignoring this thing, again, it's not a very good idea, because there's a lot of information that can be gleaned from the markets on a day-to-day basis. It doesn't mean that you necessarily have to react on a day-to-day basis, but it does give you information all the time. So let's take a look at the S&P 500. This is a monthly chart of the market, and as you can see, we've had two peaks right prior to the previous two recessions. We had one in 2000, and then we had another peak in 2007. And since the last crisis and the last recession, we were able to break through those previous two highs, and the market hasn't really looked back since. We had a couple of issues somewhere between, call it, middle of 2014 to the beginning or middle of 2016, where the market didn't go anywhere. It went kind of sideways with a lot of volatility on the downside there. But generally speaking, the trend line continues to hold pretty well. The recent little blip here from the volatility this year is a little bit concerning, but again, we mentioned that the February low was retested twice, and it seemed like the market just kind of bounced off of that, and we'll just have to keep an eye to make sure it's holding above those previous lows, and as long as it does, I think we're okay. Looking at a different chart here, this measures what the difference is between stocks and bonds, which one is performing better. And in a world where capital could flow freely across markets, across sectors, across economies, we want to really see what the market is telling us in terms of performance from risk-free bonds and risky stocks. So the green lines here indicate that stocks are outperforming bonds, and the red line indicates that bonds are outperforming stocks. And as you can see, it does go through cycles, and at times it's better to hold bonds than stocks. Right now, even with this recent volatility in the first quarter, stocks are significantly outperforming bonds. And given where we are with the interest rate scenario and higher interest rates, I do, and we'll talk a little bit more about it, I do prefer to hold stocks over bonds still. So. Now this chart here is a little bit busy and looks more like an EKG than anything else, but this is what's called the put-call ratio, and this is basically measuring how complacent or how fearful the market is. And as you can see, at the beginning of 2008, and this shouldn't come to a surprise to anybody after a solid 2017, the market was extraordinarily complacent and thought that it was all rainbows and unicorns going into 2018. So there was very little risk as far as the market was concerned and what the market was telling us. After we started to see the volatility pick up and we started to see that drawdown, inevitably the market swung from euphoria to fear, and at the end of the month, we saw a significant amount of fear built into the market. The good news is that the market seemed to have settled down a little bit, and we're still within that channel right there, where we're in a fairly neutral, level-headed playing field right now. Moving on to volatility, and speaking of, I don't want to minimize the recent volatility uptick that we saw, but as you can see, the spike in February was significant. We did see some recovery of that volatility, but I think a better picture of volatility is something that we're going to look at in terms of a longer-term chart. This chart here is it's the volatility index. By the way, the VIX is what's typically referred to as the fear gauge. So the higher the fear gauge is, the more pullbacks you could expect. And as you can see, even with this big drawdown that we saw, the volatility of the recent quarter was nowhere near as bad as some of the ones we've experienced in the past prior to the Russian default time, and back at the tech bubble, and then obviously during the housing crisis, as well as in 2011, and even as recently as middle of 2015 when the United Kingdom decided to leave the EU. So when you pull the lens back, I think it's a little bit more important to see what's going on in the context of overall market conditions. Obviously, for traders on a day-to-day basis, the volatility numbers are important, as well as what's going on from a technical perspective. But as long-term investors and longer-term fundamental investors, I really want to look at things that are going on to determine whether or not we're in a significant drawdown environment. One of the ways I do that is by, as I mentioned earlier, pulling the lens back and looking at longer-term measures. And this here is a weekly chart of the S&P 500. I did make the actual S&P 500 invisible, and what the blue line is shown is what the moving average is of the weekly S&P 500 over the previous 10 weeks. The red line is the previous 50 weeks, and the green line is the previous 600 weeks. And as you can see, anytime the 10-week average crosses below the 50-week average, with a lot of weakness, it does portend further weakness in the stock market and potentially huge drawdowns, as we saw, obviously, in the tech bubble time. The same thing happened at the end of 2007. The 10-week average crossed below the 50-week average. And when we started seeing that happen with a lot of weakness in the stock market, we obviously all know how bad 2008 was. So these are indications that we have some real problems in the stock market. But again, you don't want to simply hang your hat on a couple of these charts, because as you can see, in 2011, we saw the 10-week versus the 50-week end up crossing over, but it looked like it was with a lot of weakness, but not to the extremes. So this was more of a correction in the near term, and the market continued to move higher. Similarly, in 2015, we saw that crossover happen after Brexit, and it did so with weakness. And so this was a head fake, and another reason why you can't simply just look at charts when you're trying to make major investment decisions and trying to achieve longer-term objectives. So the current environment. What does our car look like? As we mentioned earlier, we're going to take a look at 4 different components. So let's start out with, as far as the economy is concerned, I've been pretty positive, and I continue to be pretty positive. Employment numbers are good. Wages are finally growing. Lower taxes with reduced regulation should help businesses and consumers, and thereby continuing economic expansion going forward. Turning to earnings, again, very positive. Mentioned at time of this video, we just entered first quarter earnings reporting season. So far, earnings have been terrific. In addition to earnings being strong, we continue to receive positive guidance from companies, and as long as these earnings continue coming in at these levels, I think we should be in good shape. From a valuation perspective, stocks are not cheap based on the 12-month reported earnings, but if earnings do continue to come in as strong as they have, as I expect, at least the stock valuations, in my opinion, are justified, and that can propel us higher from here. On the fixed income side, credit spreads are tight on both investment grade and high yield credit, but as long as spreads don't widen out too much, I think we should be okay in those credit sectors. The one thing I am keeping an eye on is interest rates. Interest rates are rising, and if the 10-year goes above 3%, we could definitely see some pressure on stock prices. We aren't there quite yet, but it's something that we definitely need to watch out for. And finally, the markets are relatively good. I would be generally positive on the markets as a whole, but the yield curve is flattening, and it could indicate some problems in the future. The stock market, on the other hand, even with the recent volatility, has shown that it's not quite ready to roll over, and it continues to hold its uptrend. As I mentioned a little earlier, as long as we're holding above those February lows, I think we should be okay. But we'll continue to keep an eye on things and ensure that we're making decisions based on what's going on. Turning to portfolio construction, I think this is where the rubber meets the road. And obviously, when markets are going up and the news around everything is positive, it's generally when investors are comfortable jumping in. And interestingly enough, really investments are the only thing that people are willing to buy when they're more expensive. But nonetheless, it is the emotion that we live with, and we are human beings, and we want to buy things when things feel good, and we want to sell things when things don't feel good. So when you look at it, as soon as the market starts to come down, that's when people start to get really, really concerned. And if the only thing that you're doing is buying stocks when things are feeling really good, the tendency is you're buying high, and then when things start to deteriorate, you're going to sell because you can't take the pain. And that's where you're buying high and selling low, and it's not something that we recommend for clients. Dalbar is an interesting company. They did a investor behavior study. This one's a little bit dated, goes back to 2013, but they took a look at the last 20 years prior to that of investor behavior and how the average investor ended up relative to the S&P 500. And the reality is that investors tend to really underperform the S&P 500, and there's a number of reasons for that. We mentioned emotions. Emotions play a big role in how people achieve their investment success, or in this particular case, don't achieve their investment success. But it does take discipline to be an investor, and understanding how to be disciplined is very difficult because, again, we are human beings and we have emotions that dictate our day-to-day lives. One way that we try to do that is through portfolio segmentation and really understanding what investment strategy you are employing as an investor. If you understand those things, it could reduce the emotional decision making that you do have, but it never eliminates the emotion of the ups and downs. So let's take, for example, just a sample here of how to segment a portfolio, and hopefully if you're doing things on your own, this will help frame a few things for you. If you're working with us or with me, I'll get into a little more detail on how I do it. But let's just take a 100% stock portfolio, for example, and let's say that you carve this thing out in 3 different sections, and half of the portfolio is always going to be invested in the broad market, something that's diversified, low cost, something like the SPY S&P 500 Index ETF. And that half is never going to be touched regardless. Come hell or high water, you're never going to touch that component. But in order to alleviate some of the emotional disruption and some of the stress that you may feel, we're going to give you the other half to kind of do things that are a little bit more emotional. And let's say, for example, you take 25% of your portfolio, and when you love the market, you could buy riskier assets, more stocks. If you hate the market, just hold cash. And then the other 25%, maybe you like to hold bonds, or maybe you just like international stocks, or you want to hold a basket of individual stocks. Whatever the case may be, this will give you the flexibility to do things that you feel like you should be doing. So let's take, for example, end of 2007 comes around. You're reading all sorts of news about what's going on in the economy, and you're concerned that we're in for some potential problems in 2008. and you follow this segmented type approach, half of your portfolio will continue to hold the S&P 500, the ETF. The 25%, because you hate the market, is going to be in cash, and since you're kind of concerned about that, you're going to hold a 25% position in bonds. So what happens? 2008 comes and ends, and you are absolutely correct. There were problems in the market. The market ended up the year down 37%. But because you took the time to segment your portfolio into different buckets, your portfolio would be down somewhere around 17% in this example. Now, it's painful to see negative returns. I understand that. But in relation to what the actual market did, I think that most of us would have been happy back in 2008 had this been the only pain that we felt. So if you were wrong, on the other hand, and 2008 was the flip of this, and the market was up 37%, I'm not so sure that many of us would be upset with having a positive, call it 17% return. Obviously, we always want the most return we can get, but again, segmenting your portfolio may not have helped you that much on the upside, but it did allow you to sleep at night. So nonetheless, a good strategy and a good process to employ. So end of 2008 happens, and you realize that things have gotten so bad, and you don't feel like things could get much worse than that, and you decide to take your cash and buy the S&P 500. You decide to get rid of all those bonds that you had, and you're comfortable owning risk, and you basically now take all of that, and you're holding everything in the S&P 500. What happens? Well, after a 2-year period, 2008 and 2009, let's say you had $1 million at the beginning of 2008, your portfolio would have been positive. It would have earned just over 4.5%. The S&P 500 would have still been down over 20%. So you've been doing much, much better than the overall stock market. Assuming you didn't do anything else with regard to your allocations and you just let it all ride, you would have generated more than $700,000 in this example over the S&P 500, and having nearly $3 million, nearly tripling your money. And the reason is that the less you lose during these major drawdowns, the more likely you are to stay invested, and the more likely you are to recover when you're ready to recover. And I think it's something that's very important. I don't think a lot of people understand the significance of minimizing these major market drawdowns, and I think this example right here demonstrates the importance of that in spades. So no different than what I do for my clients. I segment portfolios here, and I do it in a little more detailed manner. But nonetheless, I have two different parts of my strategies. I have a long-term allocation as well as a short-term allocation. My long-term allocation is predicated on my outlook out 12 to 18 months. Anything beyond that I think is too difficult, as forecasting is difficult that far out. But right now, barring any sort of recessionary factors, which I don't see on the near horizon, I'm staying fully invested in my long-term allocation based on risk tolerance, and that's going to really be my core holding. On the short-term allocation side, this is where I'm looking for opportunities in the near term, 3 to 6 months out. It's where I could go across the globe, across different market caps, across different sectors. It gives me the flexibility to hold cash or bonds or alternatives depending on what the circumstances are. And before we get into the things that I like in the second quarter, I wanted to really just touch in on a couple of the things that are going to really dictate what kind of year we have. There are a number of tailwinds that I see. I think the lower taxes and the lower regulatory environment is going to be positive for businesses in general. It's definitely going to help individuals in terms of their consumer spending, having more money in their pocket. I think that's all good news. Small and mid-cap companies will benefit from both of those, lower taxes and reduced regulations. It's easy for large companies to fight regulatory regulations, but the smaller and mid-cap companies, when you reduce those regulations, it does really open up the opportunity for them as well. And I do think that there's going to be some repatriation of capital from overseas. That money will probably be used for mergers, acquisitions, stock buybacks, capital investments, and I think all those are tailwinds to the market. And as always, we have headwinds. We always do. Geopolitical risk is something that's with us all the time. It's not something that we could model, but it is a very important part of investing, especially considering what just had transpired in Syria. We have problems with North Korea, the China issues, Russia. There's always something to find geopolitically, and hopefully the rhetoric will die down, and more level-headed people will prevail, and hopefully that risk will be minimized. As far as trade wars are concerned, I think this is overblown. I don't really see much in terms of real tariffs taking hold. I do think there'll be continued negotiations between our trading partners, not only here within NAFTA, but I think with the EU and China. EU and China have had tariffs on our products for quite some time, and just the idea that we may have that we may impose tariffs on them before you know it, the whole world goes crazy. And I don't see a trade war in the cards. You never know, but I think that, like I said, I think more level-headed people will prevail. As far as a more aggressive Federal Reserve, that is something that we started out the year with as economic data was strong. I don't see the Fed raising rates much more than the 2 that they plan to do for the rest of the year. That could change if inflationary pressures do build significantly, but I'm hard-pressed to believe that the Federal Reserve wants to tap on the brakes, given that fiscal policy is finally caught up with the accommodative stance of the Federal Reserve and monetary policy. So all in all, I think 2 more rate hikes this year would be my best guess, and we'll move on. So based on all those things, when you look at everything in totality, what are some of the things I like in going into the second quarter? I mentioned that I like, in general, stocks over bonds. I think given the level of interest rates today and the rise and the potential increases in interest rates, I'd much rather hold stocks given the 4-part framework that we just looked at, given earnings and the economy and where valuations are. Within the stock market, I do prefer to hold small and mid-cap stocks. They should benefit from lower taxes as well as reduced regulations. International stocks are just cheap relative to the S&P 500. I think there's some benefit to having exposure there. Technology, I had an overweight in tech, and I continue to hold an overweight to tech. Given the guidance, given earnings, I think those are all positive for that. The repatriation of capital, given that some of these businesses are behind the curve and are in desperate need of some technology upgrades and increased productivity, I think that's all going to benefit the technology sector. On the fixed income side, I prefer to hold credit, both high yield and investment grade. We talked about the spread levels being on the tighter side, but nonetheless, until we start seeing some spread widening, I still favor these sectors. I do like floating rate bonds. It should insulate us from increasing interest rates, so both on the investment grade and on the high yield side. The things I don't like going into the quarter and this year in general are interest rate sensitive things. Long duration bonds are extremely interest rate sensitive. I don't believe that there's any reason to hold long dated duration bonds. If you take, for example, a bond with a duration of 10 years, if interest rates spike up 1%, you could expect about a 10% loss on those bonds. And given how flat the yield curve is right now, you're really not giving up much in yield to go out, to stay on the front end of the yield curve. So overall, I prefer the front end of the yield curve over the long part of the yield curve, as well as obviously credit instead of interest rate risk. The stock sectors that are impacted by interest rates, utilities, REITs, staples, again, interest rate sensitive, and those are a few sectors that I'd probably stay away from right now. So, kind of wrapping things up here, discipline matters. It matters a great deal. I understand that people have feelings when it comes to financial markets, but you need to control your emotions. When things are going bad, investors turn to the internet to confirm those fears. When things are feeling good, they again search out information that confirms their feelings. It's kind of like going to WebMD to diagnose yourself. No matter what kind of disease you're looking for, WebMD is going to help you help you find it. I've been in the investment business for nearly 25 years, and I can tell you that people really haven't changed that much. That's why it's so important to take a look at the whole picture. If you're only looking at one thing, whether it's the economy or earnings or valuations or markets, you won't have a real understanding of what's going on, and it could lead you to some poor decisions. That's why we talk a lot about portfolio segmentation and why it's important. It'll allow you to really allocate certain dollars to certain risk categories so that you aren't putting all your eggs in one basket. And finally, you'll have a better understanding of what your investment strategy is. In order to really reduce the stress and make better decisions, you really kind of have to understand what the what-ifs are in your investment strategy. The stress is going to increase if you don't know why you're doing what you're doing, and then you're going to rely on your emotions to make your decisions for you. So again, take a look at everything in totality and make sure that you understand what your investment strategy is implying. I'll leave you with one final thought. For too long, I think the financial industry has preached a buy and hold strategy. They typically tell you to live through some of these ups and downs because you're a long-term investor. But what happens when another recession hits or we see another major drawdown like we did in 2008? The question always is, are you going to have enough time to recover? The reality is that some of you may and some of you may not. And I think that by taking a more holistic picture and a holistic view of what's going on in the world, I think you'll have a better opportunity to segment your portfolio in different buckets and hopefully not experience those major drawdowns to the fullest extent. I hope this video helped you with some ideas on how I look at the markets, and always remember that you don't need to do this alone. If you do want a second opinion or you have any specific questions with regard to what you're doing, please give me a call or send me an email. I'll be more than happy to chat with you. Feel free to go ahead and share this video with any of your friends, family, or colleagues. Thanks again for watching. I hope you have a great quarter, and we hope to see you again next time.